This interview was recorded on Wednesday, March 16th, 2022, Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Michael Oliver of Momentum Structural Analysis. I spoke with Michael back in September of 2020, so it's been a while. But back then, he was saying that there's going to be a shift from the stock market to commodities, that investors would, their preference would start shifting. And he's been completely right about that. Gold and silver, of course, have consolidated for a long time. But today, it's an interesting day because we just had the FOMC. And Michael always talks about the fact that we have to ignore the news and events. So I couldn't have asked for a better day to speak with Michael. I wanted to speak with him last week, but I think it was the best thing to wait till today. Welcome, Michael, and thank you for coming on the show.
Good to be back, Mario.
Yeah, so what you were telling me before you started that you really think that gold and silver are going to come to the fore right now, that the bond market, especially treasuries, are not acting as a counterbalance to the dropping stock market. So could you elaborate on that for us?
Yeah, if you're an asset manager running a big fund, and not Goldbug, just like a Ray Dalio of the world, okay? And he's even expressed this some months ago that you got to quit paying attention to the price of your stock and pay attention to the real underlying value of your money unit, because it's decaying rapidly, okay? That was his concern. Money supply growth, for example. And he's not the only one that has expressed doubt about the risk reward right now of the US stock market. At one point, in 2009, we were major bullish, like 1 week off the low, in fact, in March. But things changed. We went from 600 something to 4,800. So 12 years, we've created, in effect, if you look at an S&P monthly chart, and I think this is critical for even gold analysis right now, you've got the biggest bubble in US stock market history, both measured in time and percent gain and the curvature of the chart. 1929 top, 1980, no market top in history. The United States matches what has just been produced. Then if you look at an M2 chart, money supply, get it from the Federal Reserve of St. Louis, you can get it online. Or get a Fed funds rate chart from the same St. Louis Fed and look at them, and you'll understand why we have a stock bubble of the proportions we've had. I mean, they've blown money supply off the page, especially in the last 2 years. It normally doubles every decade. Now it went up 40 some odd percent in 2 years. Look at the Fed funds rate chart and see the staircasing decline that it's had over the last decades and laid low near 0 to 2.5% for the last 12 years. So no wonder people plowed the river flow of money into the stock market. But like many markets, they overdo it. This time they overdid it big time. By our metrics, the stock market as an asset category, especially the US stock market, has turned down. We think it's begun a bear market. It will not crash. Bear markets in the United States, with one exception in 1929, have never started nor involved crash events, where like in 3 weeks, you go down 35%. That happened in March 2020, and sure enough, that wasn't the beginning of the decline. It went back and made a new high. Most bear markets are arduous, arm wrestling, confusing processes. We think their asset category, I say they, the Fed, one of their favorite asset categories that they will say is the stock market. They like to defend it. Whenever it's in trouble, they come to the defense. They also care about things like muni bonds, municipal bonds, and high yield corporate debt. In fact, over the last couple of years, they've been outright buyers of certain ETFs that cover high yield corporate debt. Outright buyers of the ETFs itself. Now, those markets are now dropping. Now, the stock market's dropping in an arm wrestling manner. It has broken certain levels that for us determine beginning of bear market. not price chart levels, but long-term annual momentum trend levels, which we measure differently than most people measure price. I won't go into the details. We are now convinced that you've seen your top in the stock market, and it's going to proceed in a zigzag negative direction, probably for a year and a half or so, and probably a major percentage decline. So too is the behavior of the muni bond market, which means state and local government funding, and high yield corporate debt. They all look in jeopardy. Now, these are three asset categories that the central bank cannot afford to have go whizzing to the downside, as broken bubbles tend to do. So all their talk about they're going to fight inflation by raising rates a quarter point for the next 7 months, et cetera, that's great, super talk. They reference data points that we're all familiar with, that we get on CNBC and so forth every month about the unemployment, or we get the retail sales, or we get, et cetera, et cetera. They're looking at those numbers, and they're historic numbers they're looking at now, because every time you get them, they're already old. China's probably entering a recession. Their stock market certainly is by our metrics. Europe is probably on the edge of one, if not already in it. You think the US is going to escape that? That's step one, to observe that, because if those asset categories are in fact headed down, what is the central bank going to do? They're going to continue to tighten to help facilitate the decline? Or are they going to suddenly say, well, we've got to be cautious, which is a word they're using a lot lately. So these expectations of Fed tightening and so forth are probably very much misplaced. The other factor in the process here is lag to gold, very much so, but we talked about it in our last meeting, is the commodity upturn. In fact, a month after you and I talked last time, commodities exploded up out of the hole. It'd be October of 2020. Most of our trigger numbers for the Bloomberg Commodity Index and many of the major markets, the grains, copper, crude oil at $40, we got bullish, et cetera, they've exploded. Now, everybody thinks that that's, a one-time event, and it's only because of the Russian situation. Well, I admit that Russia, for example, could have helped facilitate the last 30 or so bucks up in oil. But basically, oil had gone from like $10 to 40 to 75 and 80 before Russia ever got on the map in terms of the Ukraine problem. So you can't blame the explosion in commodities, which began a month after we talked back in 2020, on that event. That's merely an ancillary event on the sidelines that happened to coincide with what was already underway. What we think has been happening is that the monetary policy of the Fed, the BOJ, and the ECB, which has been very, very easy money for the last years, and is likely to go back that way soon, has been to inflate one category beyond reality. And while commodities between 2016 and 2020 were like a submerged beach ball, historically, you could even see it on the price charts. Most of the commodities or the Bloomberg Commodity Index. It's like they went down to theoretical zero. They're not going to go to zero after all, but down to price levels that were just so low and stayed there for 5 years, which naturally, if you stay too low for too long, you tend to distort supply demand to some extent, especially supply. But the monetary policy was ongoing. So that inflationary bubble, that river flow of capital, finally some asset managers out there who are not normally gold or commodity oriented said, hey, there's lower risk, better reward in owning oil stocks or owning fertilizer stocks, which we suggested about the time we spoke. In fact, they've tripled since. Commodity related stocks have been great performers along with the commodity complex. The problem with the central bank thinking it's temporary is our analysis of what just happened over the last year and a quarter or so in commodities is that on an annual momentum trend basis, where trends tend to last 3 to 5 years, by the way, this is a fresh upturn. And yes, it's been large percent gain, but it came from very, very low levels. So yeah, the percent gain is terrific, but it's still not in many commodities at super stellar levels. So we think that one, the error in their thought is that it's going to subside and therefore, they won't need to tighten, but that commodities are going to stay up here, probably even higher levels than they are now. But the point is not that they're too high, so they're going to stay up here at a new range instead of the range they were in for 5 years underwater. And even staying at current levels and going sideways is a stranglehold on the global economy in many ways, which is going to what? Cause the central banks to have to rethink all this so-called revision that they're now getting into. I think gold knows that. Gold is not a market that is prodded by external events. It tends to anticipate the events well ahead of time. Gold as money traces back 2,500 years to a part of Turkey where they first minted gold and silver currency by the government at the time. It was 550 BC, okay? It's been money ever since. It's a fairly wise market. It's been money across the globe, not just in Europe or so forth, but going to Africa, South America, wherever. It's money. It's been there a long time. Compare that to the S&P, which has been around since 1957, or the Fed, which has been around 100 years. They're babies, okay? Now look at what just happened to gold over the last, since December of 2015. The low monthly close on gold at the end of that bear market was $1,060. Between then and the summer of 2020, again, summer 2020, gold doubled. Commodities were still in the hole. They didn't even upturn until October 2020. And so now everybody's looking at commodities and saying, well, why isn't gold exploding? Because gold led. It's the leader. It doesn't wait for these events. It anticipates them. It's in charge, so to speak. I've never said this in our we've been around for 30 years, MSA, providing institutional research and research to individual investors. I've never been so narrowly focused in terms of what I think is likely to be the winner going forward for the next year or two. Yes, commodities will likely stay up and trend up, some of them even more than they have. I think we look at some of the underpriced commodities, for example, sugar and cocoa. I would also watch natural gas. Those three markets have not gone totally berserk yet, and I think they will. But gold will lead them on a percentage gain basis. It did back in the late 70s during that big bull market in commodities and gold. Gold still led them in terms of percent gain. We think gold and silver, which have been, like you noted, in a corrective process for now over a year and a half of sideways to down, constantly being beat up by Fed news, especially since June of last year when the Fed said we're going to taper, okay? There have been like 4 sell-offs in gold that each constituted more than $100 drops, but they were all redundant, meaning you sold it, you made $100, it came back up to where it was before they sold it again. They couldn't get it to sustain on the downside. And now we've shot back up and tapped the high again. Got back up to 2,050, actually a little above there. So we've matched the summer high of 2020. We got some profit taking up there. No big deal. Silver is also engaged up out of its congestion pattern. It's not evident on the price chart, but when we run our quarterly momentum oscillators of silver, it's broke out clearly in the low 24s, $24 area, shot up to the mid 27s. It's now 25, 26 zone. We think silver is now also engaged. The gold miners and silver miners have also engaged to the upside out of their congestion process. For example, GDX, which is a very popular gold mining ETF, it's also got about half a dozen silver miners in it, was trading in the last week of January this year under $29. Between that low and the 5 subsequent up weeks, which were all up each week, it went to over 40. It was nearly a 40% rally in 5 weeks. That was a statement. It says, I'm through of the corrective process. While commodities might pause for a while because they've had a pretty big gain, the overall commodity complex. In fact, it overshot most of our objectives. It was so strong. It could easily go into a congestion zone, but we argue it's going to be likely a high level zone, which means stranglehold on a lot of other economic metrics. But it looks like gold and silver are ready to re-engage again. And they don't need an external factor. And it isn't Russia, okay? I've never seen gold trend based on war. Besides, I'm not sure how long Putin's going to be able to hold this together anyway. But think of gold as a separate leadership market. And I'll give you one more example of what not to look at. Everybody's looking at commodities saying, why isn't gold gone? Well, gold went first. Okay, two, what about the dollar? Everybody thinks the dollar's strong. Well, they're misfocused. If you go back to 2015, December 2015, when gold made its lowest monthly close, that was 1,060, the dollar index, which is overwhelmingly weighted by the euro, by the way, therefore it's a totally distorted index, was at 98.65, 98.65. It's trading at that same price today. 6 years later, it's oscillated in a range of about 5 or 6% above that number and about 5 or 6% below, an extremely narrow range for 6 years, meaning the dollar has gone nowhere since late 2015. Meanwhile, gold doubled. So even the dollar didn't explain the gold move. Gold doesn't need it. Gold is looking at the monetary degradation of the major currencies, which is a competitive process. Sometimes the dollar degrades more than the euro or the yen and so forth. It's competing garbage, okay? But that's what gold is looking at. And right now, whatever the central banks do in response to a declining asset categories that they want to defend, we argue the flow will not go where they want it to this time. This time it's going to be like the late 70s. They can print all they want, but it's not going to help the stock market. Stock market was a wasteland through 1982 back then, even though the monetary policy was aggressive. It went into gold, into commodities. We think we're in the same situation now. And while T-bonds over the last couple of years have been a competitor to gold in terms of going up with gold and down with gold in price, in other words, asset managers fleeing the stock market would go and buy T-bonds or buy gold. That's no longer the case. T-bonds are now matching the stock market on the downside. So we're left with one major asset alternative. And I think that's where investors need to start thinking and focusing is on what has been fairly sedate for a year and a half, the gold sector, silver especially, and the gold and silver miners especially. That's where the focus should be.
Could you tell the viewers a little bit about the miners and the general stock market? Because people are always concerned that if you have a bear market in the general stock market, that miners won't go up. But you can tell us about what happened in 1930.
Well, in the 30s, we know home stake mining went up 600% while the stock market went down. It was the biggest gold miner back then. And so it was totally opposite. Okay, we know that. There are a couple of exceptions in history where very briefly, and I mean you could measure it in weeks, you would find that gold miners collapsed with the stock market drop. One was in late 2008, when the S&P had already been going down since October 2007 to about October 2008, been down for a year. Finally, gold joined in, and they had a quick corrective sell-off, turned up, it was back at its high within about 4 or 5 months, whereas it took the stock market a couple of years to get back to the comparable high. So there was some joining there in October, November of 2008, where gold did go down with the stock market, okay? The next instance of that was in March of 2020, which is burned in everybody's mind. The S&P peaked in January 20. In February, we put out a sell signal. In fact, we said it would be a crash. It would be a dynamic drop, not a timid one. In fact, it was crash dimensions, 35% in several weeks. In the last 6 days of that crash, GDX finally joined in with the S&P because there was general margin call selling of assets all across the board, so it got caught too. And it had a 6-day mini crash that looked like it was replicating the S&P. And it turned and burned after that to the upside. By summer of 2020, 3-4 months later, GDX had gone from $16 to upper 40s. Okay, percent-wise, beat the heck out of the S&P's rebound from there. Okay, now, recently, with our call of the stock market top, which we issued in January, we've seen the stock market drop, and a lot of gold, silver mining investors have thought, oh, golly, the miners are going to have to join in. Well, here's my suggestion to put to end that fear. Get a weekly price chart of the S&P or the NASDAQ 100, preferably. Go back to the December high and look at what's happened from there through this month, and then get a GDX chart. Like I told you, was at under 29 early this year, shot up to over 40 during the same number of weeks, the S&P and the Dow and the NASDAQ have been declining. It's been going vertical, totally opposite. And we think that that says something. Also, we notice, for example, that while a lot of the mining ETFs have turned up in our measurements, they haven't gotten necessarily to a new high yet. But Newmont Corporation is the largest gold miner out there. It's the blue chip of the blue chips in the industry. If you're a large multi-billion-dollar asset manager and you make the determination that you want to shift some single-digit % of assets out of the regular stock market and into a more defensive position, and gold being one of those categories, you may not go buy gold, but you'll buy the gold miners. You're not going to buy the penny stocks. You're going to buy the blue chips. Look at a Newmont chart. It blew off the page recently, made all-time new highs above the highs of 2020. That's indicative to us that, in fact, large asset managers, not gold bugs, have made a commitment, and they don't generally twist and turn every 2 weeks, okay? When they make a commitment, they're making a commitment. And they've made a commitment to the large gold miners. And it's a statement, I think, about their assessment of what's underway here. And we agree with them. So we have a narrow focus now. It did include commodities, but commodities have had a good move. And I think they'll underperform gold from this point forward. And therefore, I would focus on what's a very small sector on a percent basis, the gold miners and silver miners.
Yes, and I guess fund managers that specialize in overall markets, they don't even have to shift like a huge percentage of their funds to make a difference to gold and silver, because there's been so much paper inflated into the system that just a little bit, 1 or 2% could make a huge difference. Just wanted to ask you to wrap up, and I actually don't really like to look at price targets, but I've listened to you speak about what gold has done in the last few bull markets of the last 50 years. So maybe if we could wrap up with your projections for gold and silver.
Well, let's take gold first. If you go back and look at the 3 major bull markets of the last 45, 50 years, you'll find that they go to the bear market low that preceded the bull market peak and measure it. They were all 7 to 8-fold increases in price. They all replicated each other on a logarithmic scale, so to speak. Well, our bear market low was 1,050 area. Okay, you do the math. What's 7 to 8 times that? That's just a normal replication of 3 prior bull markets we've had in the last 50 years, and yet we have fundamentals that are far more exaggerated than they've ever been, both monetary and the downturn in the asset category that's likely to spark more monetary excess. So gold going up to 7 to 8,000 is merely echoing the 3 prior bull markets on a logarithmic scale. And I frankly think that it won't stop there. But let's just say we're going to do the normal thing, okay? Then look at silver on a ratio basis or a percent price of silver versus gold. Go back 50 years and you'll find that there are 4 times in that 4+ decades where silver has reached 3% of the price of gold, twice reached above there. One time got to 4.5% of the price of gold, and one time it's 6.5% the price of gold. Okay, so let's just say the lower end there, there's 4 peaks, 3% over. Let's say that's sort of where we think maybe it'll return there again. You know, no big deal. Well, 3% of the current price of gold puts silver at about $60. Okay, if gold ever went to 8,000, silver could be 240. The issue then is, well, is silver in a position to outperform gold now? Because since 2011, we know it's underperformed. It's gone down a lot more, been more suppressed than gold, and less of a performer. That changed in the summer of 2020 when silver had that explosive move. It broke out on its spread charts, long-term measurements of silver versus gold. It broke out and turned the trend to positive. It did pull back in the recent pullback in silver the last year, but the pullback didn't negate the positive trend, and we're now reasserting again. So it looks to us like, one, gold and silver have said, we're out of the congestion mode, we're going to trend upward again. That's net price. Gold is likely, wouldn't surprise us to see it have another normal bull market, despite the abnormal fundamentals that could drive it much further. And silver could go out to its normal 3% over gold again, in which case you're talking price dynamics in silver that would rival the move in Bitcoin in 2020, when Bitcoin went from 10,000 to like 65,000 in 9 months. Okay. We also think that this next leg up in the gold and silver is likely to be far more dynamic and speedy than what we're used to. In other words, we might end up with days where silver ranges $5 a day and gold ranges $100 a day. Might be routine in the process of the advance. Anyway, but it looks like history is set fundamentally and technically for gold to be the absolute winner here.
Well, that's the way I see it as well. The only thing I would say to the viewers is that you just got to sit tight and be patient. And before we finish, Michael, could you tell the viewers where they can find your work?
Sure. It's www.olivermsa, MSA for Momentum Structural Analysis.com, olivermsa.com. We've got an explanation on there about our methodology, why it's different, rationale for it, sort of how it works, show archival history of our calls on the stock market going back to the mid-1990s and so forth. So a lot of explanatory material there, and you can request a sample copy of the research.
Great. Michael, thank you very much for your time. And hopefully we won't wait that long again to speak again. I wish you all the best.
Thank you, Mario.